So tonight, what I want to do, finish up the financial analysis. I'm going to have a kind of a impromptu kind of no points quiz as well. So I'm giving you a template. I want to finish up the template, which is the ROE decomposition. We had our first team present today. They did a great job. So we've done the entire financial analysis except for this last part. This ROE is a way to really bring liquidity, solvency, turnover, and margin all together. And essentially what we're doing is say return on equity is net income over net worth. There's different ways to calculate it. I do it fairly straightforward. At USAA, we did a 5-point average. I don't know how Bloomberg does their ROE. But you can do a simple net income over ending net worth. But USAA, we did net income over the average of 5 quarters of net worth, because you can play games with these numbers, but just keep it really, really basic. And so when we look at return on equity, what we're asking is, there's a few things. One is sustainable growth. We'll talk about sustainable growth, but a sustainable growth really is your return on capital times your retention, is how much you can grow without having to go out to outside sources. And then we want to know the sources of that growth. Is it good? What we want to do is say, hey, management has gotten us a higher ROE. ROE is increasing, but is it something that should be praised, something that should be discounted, or something that is out of their control because Congress passed some law? So we got the good, the bad, and the other, not the ugly. There's nothing ugly in finance, so the good. What's the good? It's asset turnover and margin. I usually call that's true growth. That's where management really adds their value. If you're looking at CapEx, whenever I look at CapEx, I'm going to ask, how does that help time? Not asset turnover, just turnover. How is that CapEx helping revenue growth? Or how's that CapEx helping margins? That's how management adds value. The bad is financial leverage. And the other is taxes. We're not going to buy a firm just because their tax rates are really low or really high. I mean, taxes can get into it. There are some times where tax carry forwards and those kind of things can be important, but we're going to somewhat downplay taxes here. We know the Trump tax law was beneficial to corporations, and we know there's a lot of talk about extending those and making them more permanent. So that can be there, but that's going to affect probably all firms somewhat equally. So on the good side, so again, you're asking CapEx and its impact on turnover margin, which means you need to do some analysis on what is their CapEx. How are they spending their money? CapEx is essentially projects. Those things management is doing. What could CapEx be? It could be expansion, it could be acquisitions, it could be cost benefit projects. This is where management really adds their value. It's what are the things they're doing different? How are they spending the money that they could give back to the stockholders? Instead of giving back to stockholders, they're reinvesting in the firm. What are they actually doing? So go look at that number, try to figure out what's in that number. What are they spending money on? If it's Netflix, maybe it's production. And then you have to ask the question, when Netflix produces a new show, does that go through CapEx or is that entirely expense? When a pharmacy develops a new drug, does that go through CapEx and R&D or does that get immediately expense? So you have to kind of ask those questions. I'm reading a book right now. It's a really, really interesting book on capital cost benefit projects and how horrible we are at these projects. We're bad at forecasting. We're bad at assessing the risk. Really, really good book. I'm going to add it to my book reading list. It's called, boy, I hate to type it in there because I mistyped it the first time I did it. How big things get Dumb. It's a really good book. Have y'all seen this book before? The first time I typed it, I typed the word things with an O instead of an I, and the pictures that came up weren't what I was expecting at all. But this is the right book. It's pretty interesting. He goes through some major projects and he talks about why they fell. And he says that projects, capital budgeting, is not a normal distribution. It's very skewed to cost overruns, things taking too long. So when management says we want to do something, how good are they at planning? So, if you're spending 10, 15, $20 billion on CapEx, you really need to ask, where are they spent? What's the goal and how good are they at spending that? So you really need to spend some time on CapEx. But to me, the bottom line is, how's CapEx going to affect turnover and margin, affect their revenue, protective margins? So turnover is assets divided by revenue. That's turnover. Margin is EBIT divided by revenue. So you got the growth of the business. How the business growing? Are they selling more stuff? Are they expanding, going overseas, expanding throughout the United States? And then you have the profitability. That can be, there's a lot here, but one of the most obvious ones is operating leverage. Is that their cost per unit goes down just because they're getting bigger, and that makes them more profitable. That's that operating leverage side. We'll talk about this. It was interesting, a book I read, he broke the operating leverage into 4 different pieces. I thought interesting way to look at it, but essentially you would assume as a firm grows that their margins should expand because they're spreading more fixed costs out over more product. And I think most of you are going to find your firms, that's not the case. That their revenue growth is actually equal to or greater than their income growth. It's kind of unusual what we're seeing here. Leverage has 2 pieces. You have the leverage itself, and then you have the interest impact. The leverage itself, we can look at assets. Oh, I did this backwards. Anybody going to correct me on this? What's this ratio? Revenues over assets. Wow. I did that on purpose so you're paying attention. And one of my bosses did that. He put in a typo in his presentation. He said, whoever finds the typo, I'll give $1 to you. And they found like 6 or 7 typos. So he thought he only had one. So revenue to assets, but leverage is assets to net worth. Now it's a little tricky because assets to net worth is all of your liabilities, whereas a lot of times financial leverage is debt. So here we're looking at assets minus liability. It's all liability. Assets minus net worth is all liabilities. So there's more than just debt coming in here. And then the interest impact, what we want to do is say, hey, let's look at earnings before taxes over earnings for interest and taxes. So which of these is the bigger number? EBIT, right? Because it's before interest. So what is this number? This is how much of your net income you keep before you pay your debt holders versus how much you have. So if a firm has no debt, what should this number be? Should be 100%, right? They don't pay anything in interest. So their EBT and EBIT should be the same. So this one's interesting. As this increases, ROE increases, but the interest impact falls. So as you have more debt, you're going to jump up your ROE part, the assets to net worth, but the interest impact can be greater. So what you're really looking at is which has the bigger impact, leverage, assets to net worth, or the interest impact. For most firms, as they add debt, the leverage part has more impact than the interest impact part, and ROE goes up. Remember, ROE rises as long as the return on assets is greater than the cost of debt. So as long as your cost of debt is lower than your return on assets, then more debt is going to increase your ROE. Is that a good thing? So you return, that sounds good, right? ROE, I've heard accounting classes say this is the equity multiplier. It's like this wonderful thing. You increase your ROE. What else goes up when the ROE goes up? ROE rises with debt, as does what? That four-letter word starts with a W, as does WACC, right? I mean, as you know, your required, I guess KE is what we can say. Your required return rises as debt rises. Why? Because as Sebastian said, because risk is higher. So can you add value by increasing your debt and increasing ROE? No, because the return you need goes up at the same time the return you get goes up. You're just making the firm riskier. So you said we're earning more, but stockholders are like, you got to earn more because you're a riskier firm now. So we'll get a little bit into that, not too much in that. That's more when you take corporate finance, you'll get into those issues in detail. So the leverage side is, I say bad, but if the only reason the ROE is going up is because they've been leveraging the firm up, you really got to say this firm is not getting more profitable, it's just getting more risky. And you're seeing a lot of this, right? Because what are firms doing? They're borrowing money to buy their stock back. That's going to greatly increase their leverage. Will probably increase their ROE, but not for good reasons. So I'm really looking at is turnover margin improving as my main measures of management added value. And then taxes is just net income over earnings before taxes. And if the tax rate is 21%, then this should equal 79%. It's the amount of income you get to keep from the tax holders. All right, so we break this up in all these pieces. You'll notice that revenue is there. Revenue is there, so those two cancels out. Assets is in the denominator there. Assets is in the numerator there, so that cancels out. EBIT is in the numerator there. It's in the denominator there. EBT is in the numerator there. And the denominator there. And you finally end up with net income over net worth. So essentially what we're doing is we're trying to assess ROE from a standpoint of management value added versus financial leveraging and tax law changes. And so at the bottom of your print page 1, I've got it broken out for you. Asset turnover net margin, you multiply the two together, that's essentially your return on assets. The tax impact, the interest impact, financial leverage impact, the combination of those two gives you that combined impact of financial leverage, and you get return on equity. So if we look at Walmart, the return on equity used to be 17%. Now it's 19%, 20%. So have they done a good job? Just looking at ROE, it looks pretty good, right? 17% to 20%. But look at their financial leverage. It went from 196 to 234. So their financial leverage increased a bunch. What would their ROE back here have been if their financial leverage was the same? Look at the spreadsheet. You can just copy it over. If they had the same financial leverage back then, their ROE would have been 20.9%. Now it's 19.9. So you can see leverage is the main reason their ROE is higher. Why? Because we can see asset turnover times margin has actually declined over time. It went from 12% down to 11%, but you also notice it's improved dramatically since 2020. I'm not saying COVID saved Walmart. COVID certainly helped Walmart, but I think Walmart's been doing some pretty incredible things outside of COVID that's helping them as well. They have come back pretty strongly from kind of their all-time worst year, 2020, and have improved quite dramatically. They've improved their margins. They've improved their turnover. So this is a firm. So don't just look at the beginning and ending numbers, because that's all the CAGR does. Look over time, see how they were before COVID, how they were after COVID, and try to get a sense of what's causing this business to improve over time. All right. So get out a piece of paper. Y'all have paper? You may have to borrow from somebody.
I'll give you one.
If you want to do a blank Word document, but you have to trust you have a blank Word document, but try writing it out. I don't need it. Y'all need it. All right. So I want y'all, I gave you a template. It's my template. I like the template. I want to see how much of the template you can remember. I was thinking about this today, listening to an article on AI. So do you need to have a template that off the top of your head you can reference? So Luke just went through an interview where they're asking them those kind of questions. So, so is the world really changing with AI? So my theory, maybe it's changing, y'all may disagree, that my theory is what I call visual intelligence, is that when you hear a problem, you automatically see the entire landscape. You have a deep dive into all those things. So my specialty, which is a bizarre one, is balance sheet immunization. That's where I sunk my teeth into it. If you bring me up like a Silicon Bank, I can see the whole picture pretty fast. I remember all this debates on the different sides of ALM matching and duration matching, key rate duration matching, all those kind of things. I still think that's important. And I actually think it's the goal of your career is to get to the point where you hear a problem, you can see the entire landscape. Isn't that where you want to be? You see the problem, you can see the entire landscape just like that. It's all just right in front of you. When I was where you are, do you think I was thinking, man, I want to be really good at balance sheet immunization? I think I was thinking that as a senior in college. Do you think I even knew what balance sheet immunization was? So I still think it matters that you know stuff, not just stuff off the top of your head, but you know it, that you can see the entire picture. How important is financial analysis to a finance major? I used to ask these questions in interviews. Sometimes I have my own students where I almost kicked them under the table because I was asking really basic questions. And they couldn't answer them. And I think that's true of most finance majors. I'm shocked. I don't know, Rajan, you see this? You have someone who's a senior in finance and say, do a financial analysis, and what do? They do the current ratio and nothing else. Have you seen that? It's the only ratio they know.
I just created it, gave back an exam today, so it's not the correct time to ask me.
Yeah, so you might, I don't want to demoralize that too much, but it's amazing. It's kind of like walking to the doctor's office with a pain and the doctor pulls out the anatomy book to see which side the appendix is on. I mean, what would you do? Would you stay with that doctor? No, you'd run out of room. The finance major should know what. You should, off the top of your head, say, finance analysis. Yeah, I'm gonna go do these things. So write out the template. If anyone can get the entire template, I'll pay them 10,000 bucks unless I change my mind later. 10,000 bucks is on the line. I'll give you 3 minutes to write out the entire template from memory. All right, so go. So this is old school. This is the way I started off. I started my job and just learned everything I possibly could. So that's what I love about finance. Finance pays you what you know. AI might be changing that. I don't know. I hope not. I'm glad I'm not in that world if that's the case. So, but let's see if someone says, how would you do a financial analysis of a company? What's the first area you look at? Short-term viability. And what's the second thing you look at?
Growth.
Long-term prospects for growth. So that's what stockholders want, is growth. But you better make sure the firm's going to be in business before you do that. So what's the two things we looked under short term? Liquidity and solvency. All right. And then how do we summarize that? I give you two things there. Well, that's under liquidity. So net working capital. That was one of them. How do we summarize solvency and liquidity? We looked at two things there. CapEx is here. It's the free cash flow growth in use. That includes CapEx. Yeah. So how do you summarize up? So if a firm is struggling, what are you worried about? What are they going to do? They're gonna cook the books, so quality of earnings. So how do you call it? That's why I gave you Howard Schultzen, whatever his name is, his book is how can you forensically find out if management's cooking the books? Could be important if you're looking at Enron or a firm like that. And what else we look like? Could you go to an outside party to get some help?
Credit rating.
Credit ratings. I always like looking at credit ratings. I think the ratings do a really, really good job. They're a good outside source of this. There are times where credit ratings all you need. You know, if Johnson & Johnson's AAA rated, you're probably not that worried about their short-term viability. You can still look at it. You still want to know if their working capital is being managed well. But remember, net working capital also goes under turnover, so you're kind of going to look at that anyway. Insolvency, what do we look at? Times interest earned, their ability to pay the debt, and then debt to EBITDA. All right. This is a good template in the fall and the spring when we do financials. We're going to see we're going to have to throw a lot of this out because you can't use this stuff. You don't talk about working capital when you're talking about banks and insurance companies. You don't talk about debt when you're talking about banks and insurance. So we'll have to find, they do have their liquidity ratios, they do have their solvency ratios, but they're not these ratios. They're very, very different. But for most entities, this works pretty well. All right, what were the two things we looked at over long-term growth? Turnover and margin. I don't know how to spell turnover. What were the three things we looked at on our turnover? Yeah, asset turnover. What's the basic one? Yeah, revenue growth. That was the big debate your team was having, like, wait, I don't know if yeah. I noticed Reed got off that slide really fast. So it's like, hopefully don't ask a question on this one. But yeah, they showed revenue growth for their industry versus other industries and a chart they were kind of debating about before they presented. So what was that in-between thing we talked about? This is actually a pretty important one. C versus T. Capacity versus turnover. Y'all remember that one? I like this, and every time analyzing a firm, I do this. So what is it that they do that most drives their revenue growth? Is it their employees? Is it their property, plant, and equipment? Is there stores that they build? Is it the number of hotel rooms they have? Is it their proven reserves? Is it a pipeline miles? What is it that they have? And how is their revenue growth compared to the growth in that capacity? Oh, they added 10% more employees, but the revenue only went up 6%. Well, that's not good. So I really like this one. You have to pick the correct turnover. It needs to be really specific to the firm, but I really like that one. The USA, we did revenue per employee. And then margin is pretty simple. We did two margins. What were those?
Gross and net.
Gross and net. So pretty straightforward. I use an EBIT to revenue for net. Why'd I use EBIT to revenue? Because it fits in that ROE decomposition. EBITDA is fine, but you can't really fit the EBITDA into the ROE decomposition. So, and then that kind of gives you the last one. What's the last thing we looked at? Bring it all together. ROE decomposition. Now, if you did it the way I just said, it wouldn't make sense. You got to get it into a conversation. So if they ask you how you analyze the firm, you say, you know, I start off first and make sure this is the viable firm, that they don't have any serious solvency issues. So I'd want to look at this, the liquidity and solvency. Liquidity, I'm really concerned about your working capital management. You want to be able to just off the top of your head, be able to say that. If you're a finance major, you just have to be able to get to that point that you can just rattle it all off without having to think much about it. So. All right, so no one won the $10,000 tonight. I'll up it to $100,000 next class. We'll see. Now, maybe this isn't your template, but do you have a template besides this one? So that's the one thing I always notice is everybody uses current ratio, which is the one ratio I don't even like. But why is that the only reason? I don't even know why that's the only reason that they brings up. I think it's over taught in the accounting side, and so they bring that up. But there's a lot more to it. The other thing is you need to go sit down with the company and just dive into it, doing an analysis without having to look stuff up. And that's why I think students are thinking AI changes that, because AI is just going to tell me what to do. Maybe that's the new model. I don't think so. I still think knowing stuff off the top of your head. Well, I think knowing this is going to improve what you plug into AI, definitely. So I think you start off with better questions. You can certainly say, AI, give me a good financial analysis of Walmart, and it's probably going to do a pretty decent job. Will it do a better job than you do? Maybe in 10 years, maybe it will. So I don't know. You're walking into a pretty weird world. You're the cream of the crop of the students, so you're the ones that do know stuff. So hopefully you keep your edge even with AI. There's an interesting Economist article I showed at the Investment Society that asked who benefits most from AI, the most skilled workers or the least skilled workers? And the answer was yes. That was their answer. They said the least skilled will benefit the most initially, and then they're going to be replaced. The most skilled will get caught up by the least skilled, but then the most skilled are going to be the best capable of using AI because they're going to know what's going on. It's kind of a mixed bag. I still think, I mean, just take a chance that knowing stuff is better than not knowing stuff. And then if we find out that's not the case, AI will be doing everything anyway. We'll all be, be Star Trek where there's no work, no disease. We're all just sitting at home waiting for robots to do stuff for us. And we won't even know they're robots. We might think they're actual people, and who knows what's going to happen. But I'll be dead by then, and y'all be experiencing all of that. But have a template so you understand it. So there's the financial analysis side. So let's talk about what I would do. So you have, let's say you have 3 to 5 stocks, and your goal is to get to 1. So what kind of things would you do? I would start off with the annual report, the business description. I would start with that. What does the firm say they're all about? Those are usually pretty good descriptions. You can find it in the annual report. Just read through it. They're fairly well written. Who writes those things? You don't know? Finance or accounting?
Finance.
Yeah, you might think so. I bet it's more accounting than finance, but probably working together. The investment relations team writes that. So start with that. You just get their annual report, look at the business description, read the entire thing. What if you don't want to read the entire thing? Save it as a PDF, give it the notebook, book LM, say summarize this company for me. I'm kind of like that. I'm done. So I don't like reading. I like listening because I have so many flows in my eye. It's hard to read anymore, but listening. So that's fine. Then go to AI and say, do a value chain management analysis. My company. So value chain management analysis is really, really, really good. I was listening to the CFI, Corporate Finance Institute's FMVA, and they have a really, really good segment on strategy, and they're going into a lot of this stuff. They have some really good. They did Porter's was part of theirs, but this value chain management is a big part of it as well.
Are you getting those up to CFI or just?
Yeah, I'm listening. Yeah, I had to buy a subscription, and so I'm going through the.
It's through the YouTube or for the.
No, I'm doing their actual website. FMVA. So a lot of these are on YouTube, so I haven't looked at those, but these are actually. Talk about templates. They just go template to template. A lot of them we use like Porters. They do the Porters. They have another one they use. I thought was interesting. They have the SWOT. We'll talk about SWOT. You definitely want to do a SWOT as well, which is probably the next thing there. But AI can do that. I don't know about other places. IBIS World, maybe. Others. I mentioned AI. I was going to do one on my phone, but my phone's ChatGPT just keeps telling me I can't really help you. Do you want to buy the upgrade? That seems to be its answer every time now. But the last time I did a value chain, it was really pretty impressive. But I'm sure there's other places on the UTSA library that has value chain analysis. You can just Google it, but be careful. It could be some high school kid that wrote it. So you just don't know the quality. So you gotta watch that. A SWOT analysis is really good. Those you can use AI and UTSA library. Those are really, really good. So what you're trying to do is with this first section on each of your companies is what makes them different. You're trying to, in a few words, say this is what this is the same about this company. What are some of the words we talked about? Economic moats, the SWOT analysis. Do y'all know what SWOT stands for? Strength, weaknesses, threats. So strengths and weaknesses, that's their existing, what they're doing today, opportunity, threats, or new things in the future that you're looking at. Corporate finance actually has a pretty good list. So again, template. The reason you have templates is not that you do the template for every company, but it gives you a list of things that say, oh, wow, I didn't think about that. That's pretty important. I need to think about the environmental impact or the government impact of this company. So these are things, if you have someone helping you, you could tell them, hey, go do these 3 things for this company and come back and give me a summary. You could certainly do that. One last thing I should mention is analyst reports. It might be a little early to do this, but Bloomberg has these things. The library does have them, but it keeps switching. It used to be InvestText, but I think that firm got bought out, so I should go ahead and look and see. But you just want analyst reports on your company. So Bloomberg, if you go on the Bloomberg machine, you'll find them in Bloomberg. They're pretty easy to find. You'll see it on the list of things about the company. It may be a little early. The reason it gets a little frustrating to do this early is sometimes these can be really over jargon. A lot they use. I've seen some where the acronyms, they start off with acronyms. They don't even define the acronym. So the DCF of this firm's ARQ is, it's just ridiculous. And so you're like, what does that mean? You have to go check number, look up things on Google. All right. Once you have a sense of what is this firm about, that's when you're going to do the financial analysis. You have the Excel spreadsheet. And remember, I set up this Excel spreadsheet. So you set up your company and its competitors. And I also did it where you can do your company versus the industry meeting and 2 competitors. So I do have it set up 2 ways. One is against the industry. And it goes right in order what we talked about. Liquidity, solvency, quality of earnings, credit ratings, turnover. Goes right in that order. You have it versus the industry. You can do it also versus peers. You have to set up the peers, make sure you have the right lines, but you can use this spreadsheet to do it. I'm not asking you to write up a financial analysis, but you will probably pull some of the charts from this Excel. So again, there you're looking for key issues. I can't tell you what those are if we look at your company, but looking at key issues of your firm. It really is where they are strong, where they are weak, where they are trending better or worse. That's what you're looking for. What's the story of this firm from a financial standpoint? Are their margins expanding? Is their revenue growth strong? So one of the questions the team today got was probably the question all of you are going to get is what is AI going to do to this industry? It's kind of like, when you think of an industry, it's not going to ask that question. It's going to be every industry. So my question is always, is it going to hit revenues or going to hit expenses or going to hit both? They made the argument that AI is probably going to cut the cost of production. It's probably going to cause problems with writers and actors. But it could definitely impact revenue. So they're talking about, and it's interesting to me that they were saying advertising is growing. It's not just people are moving from old advertising to digital, but the entire bucket's growing. With the entire bucket's growing, that means corporations are spending more on advertising. Why are they doing that? Are they actually getting more revenue out of it? And how long is that game going to play? So I think Reed or someone on your team talked about, maybe it was Andrew, that you're watching a program and AI is going to create a commercial 3 seconds before you start the program. Is that, huh?
Instantaneously.
Instantaneous. I mean, is that going to create better sales? And that's pretty amazing. There are some programs now that, do you want to buy the shirt he was wearing in the program, at the end of the, it's pretty crazy stuff. So, but that's it on AI. Are you seeing it in the numbers yet? In our dashboard this week, we talked about how firms are telling the markets they're going to spend $100 billion on AI and their stock price goes up 300 billion. You saw that with Oracle, you saw that with NVIDIA. Why is the stock market going up 300 billion for a $100 billion investment? I mean, it's just like the market is. So where is that coming, or is it hype? Eventually, I see that come through turnover, it's going to come through margins. Where is it going to come? And can you explain it? How is AI going to affect that? So what are you seeing in financials? You're probably not seeing too much AI in financials, except for the NVIDIAs and Oracles. Even Oracle, they just said we're going to do 100 billion over the next 5 years. And the stock price shot up 200 something billion dollars. It's just, all you got to do is say, hey, we're thinking about AI, and then it's this huge rally. All right, the next part, and this is really where someone can help you. I'll show you this file today. It's tied to Bloomberg. I can't show you. I'll show you the file and then I'll fix it so I can do it here. But that is valuation. There's an Excel file for that. So we're going to do DCF, and we're going to do the investment bank approach. That's a CapIQ model. It's already built. And then we're going to do relative value. And guess what? That's an Excel file. So I've already done all the work for you. So here's one area you really could get person assisting you to build this. So you might say, you know what, I got 4 stocks assigned to me, but man, there's one on the fence I was kind of curious about. Let's go ahead and throw that one in there. Just have them go through the numbers and just see. So do the valuations. So what are we looking for? Your screening model already told you this is a good stock, but it was using a pretty simple relative value analysis. When you get into the detail, are you going to find a stock that looks more undervalued than another stock using assumptions? So we want to get that built. So that's something you can definitely get help. And it will help, especially if you get a freshman or a sophomore helping you. It's going to help them get ahead of the game in their careers. We're doing some analysis. We are going to let some of them, if they like, do a stock pitch. We won't let them do it as part of the class, but they can do it in the investment society, get some practice. So I know Jacob said he might want to do that.
About 30.
Huh?
About 30.
Yeah, we probably can't get everybody to do them, but we could have them do it outside of society and outside of the class.
In the industries, and like in bullet bracket bank and stuff like that, how much flexibility do analysts have in like their valuation?
Oh, most you build your own. I mean, I don't know many. I mean, we should have asked, we can ask Ramsey if he's on the next call. And yeah, you build your own. When I started as security analyst, my training literally was 0 seconds. I sat down as an analyst and said, I'll do it. They gave me a bond in California and said, value this bond. And I'm like, what's the utility? And they said, well, the utility guy will train you. So the utility guy walked over with a stack of books, put them on my desk, and said, you're now trained. And that was my entire training on utilities. Utilities are really complicated. So I'm doing this California utility right in the middle of deregulation. So 2 weeks later, I go and say, hey, the bond looks pretty good. I think we do it. And the guy goes, yeah, I'm glad you're saying that because we already bought it. So, okay, great. I'm glad you needed my analysis. But there isn't, what we're doing in this class is what you, I mean, there's not much training. There are firms like JP Morgan, they're gonna take you into a kind of a training kind of a session, but it's pretty independent. You come up with your own stuff. I'm giving you my files that are pretty simplistic, but I think they work. But yeah, you essentially come up with your own stuff. I think USA were somewhat weak. There was no overarching theory or philosophy. Everybody was just doing their own thing. I think I told you the story. I can't remember, but I was outside Henry's office. He was the head of equities at USA, and he told me, he goes, Ron, sometimes I like to come out and just talk to the analysts, see what they're thinking. And I was like, why do y'all even pay us? He says, yeah, I pretty much just use street research, but sometimes I want to see what y'all are thinking. It's like, you got 40 analysts out there. It's costing you millions of dollars, and he didn't even talk to him. He did his own thing. He was a portfolio manager, did his own thing, just street research. So I think USA really wastes a lot of money. So I don't know other firms, but we can ask, Ramsey and Kevin, hopefully Kevin would join us on the calls. They're both at Jefferies, which has a good reputation. So we'll see. Angeline, she was on the call today. She's at Deutsche Bank. I would think she's going to tell you she does whatever she does. I mean, she makes up her own stuff. Yeah. Does that make you more excited, or does that scare you? I don't think there's too many more autonomous jobs than a security analyst. The training is pretty
Question on him.
All right, so I'm going to walk you through these files the next couple of classes to make sure you're clear on them. One other thing you can do in this first one, I forgot to tell you about that I do have out there on Blackboard, on Canvas. Is that us? Where are we? So down here at the very, very bottom, Bloomberg has a model that if you want a quick financial summary of your firm, it's kind of an addition to what I'm giving you in financial analysis. You just load this file, put your ticker in. You have to be on a Bloomberg machine. Here's another one from Bloomberg. It's company analysis. You might want to try that one. We're going to use this capital IQ valuation model in our class, but there are some examples in there of where you can really quick. I can't really show it to you because it's tied to Bloomberg. So I get a bunch of error messages, but you can see the type of stuff that it brings in. Very similar to my file, but just gives you another analysis. So if you want to see someone else's approach, and in this one, which is really something you should do, you should go to Bloomberg and load up their Excel models and just start experimenting with them. So somewhat to Luke's point is we steal from each other all the time. So before you leave UTSA, maybe look at 3 Excel models a day and just see what Bloomberg has to offer. Capital IQ has a bunch of models as well. Just load them, see what they have. So here's one. You put the ticker in up here. Look at all the data you have. So this is another business segments. So nice thing about this is you got some charts you can easily cut and paste into your pitch book real quickly on the firms. So pretty good stuff. Do you think there's analysts out there that use this to steal from it? Yeah, why not? In fact, some analysts build it and they share it on Bloomberg, and so everybody else is using theirs. So this is a pretty good stuff. This is more relative value stuff in some places, but it has kind of a combination of the two. Here you get the segment, geographic and business segments. Obviously, you can do this out of Cap IQ as well because I have that as well. But right there, they have Sam's Club broken out 13%. That's interesting just by itself. So I'm giving you some other models that you can use, but you have my model. And then the very last thing you're going to do, so we're going to the football chart. I did build a football chart into this model. So it's there, so you don't have to build it, but it's already in there. I was looking at CFI's football chart, and they go the wrong direction. They go up and down. Football charts go across, so I did it across, not the way they're doing it. But essentially what we're looking for is upside versus downside. You're looking at stocks that have more on the upside than on the downside. The downside, we call that, I already told you that about that, margin of safety. If you're wrong, how bad could it get? So that's the kind of stuff at the very end. So you have 3 or 4 stocks. You can look at those football charts. And you're going to look at your ranges on your valuations. You're going to make a decision. This is a stock I want to push. So you want to get real quickly through this analysis. This is high level. So you can try to get down to your final stock to pitch. All right, that's what you're after. Then when you get to this point, you're essentially going to redo this at much more detailed level for your pitch book. All right, so that's the process. So start high level, go through fast. So you'll be doing an analysis of your stocks, just higher level, trying to figure out who these stocks are. You're going to try to figure out one stock that you're going to pitch, and then you can go back and review detail. Part of the problem of this is what? If this takes you a month, what's going to happen during the month? So let's say you're analyzing Oracle. And you're analyzing it right here. You think, you know what? I think Oracle's worth 260. So you're ready to report Oracle at 260. And you're going to recommend a buy. And now you're ready to do your pitch. And it's at 326. That's the problem. So what we're doing over weeks, in real life, you do in a week. So we're taking a 1-week job and we're spreading it over an entire semester. Creates problems. So, you hope your stock doesn't move a whole lot. Isn't that horrible when you're recommending a stock at $20 or, stock's trading for 20, you think it's worth 40, you put your buy into it. And by the time it gets approved, the stock's trading for 60. You're like, see, I was right. You guys are just too slow. But if you don't get it done in time, then there's no value to the firm. These things happen. They don't happen all that often. That's a pretty big jump for a stock that's that big. I think the CEO was like the richest man in the world, not the richest man in the world, but for a few seconds there, he was the richest man in the world. Yeah, these things happen. I've had people working on a stock, and right in the middle of it, there was a buyout. Who was the firm that was bought out just this week? We were looking at that. Who was that? Yeah, EA. So if you do electronic arts and right in the middle of that, they get bought out, what are you going to do? It's interesting. It was funny. We bought Whole Foods, and then Amazon bought them out. Their stock price shot up, and I remember one of the students saying, "Yeah, we saw Amazon coming, man. We got that stock." And we had no discussion about Amazon buying Whole Foods. But when you make a good decision, you pretend like you knew stuff that you didn't know when you made the decision. But sometimes you're lucky, and you got to convert luck into skill somehow in the interview. All right. So these are the kind of things you're going to do. You have some help with the Bloomberg charts and those kind of things. So there are some Excel summary files that you can use from Bloomberg. Capital IQ. I'd recommend, I've given you 3 of them. There's a lot more of them out there. When you load Capital IQ on your machine, it asks you if you want to bring the templates in. I would say yes. It takes a few minutes for them to load. And just over time, experiment with them. See what they have. They have some M&A ones. They have some valuation ones that we're going to use. I like that one. They really like to have some financial analysis ones that will probably be real similar to what I'm showing you here. Start building your arsenal, because you can't take that stuff with you. You can take the Excel file with you outside of UTSA. You can't show it as your work. You can't show a Cap IQ file and say, hey, yeah, I built this file. All you did was change the ticker. But you can certainly look at it, steal the best part of it, and build your own file. So between now, so where are we going from here? So We have 2 screening models still to do, right? Your industries. We have 2 more screening models to build. We'll start working on those next week during your team meetings, once you get your team presentation this week. We'll try to get your buy list for all 3 of your sub-industries, so you can start working on that. We'll try, Joshua, you can help me in person, how we can start getting volunteers. Anyone who definitely doesn't want to volunteer. That's the only one.
Probably sign one report.
Yeah, if you want 2, we could probably find you 2. You can't like give them all of your work. Say, bring me coffee, bring me tea. Kind of stuff.
We're sure our sophomores, guys.
They're eager, but they haven't ever discounted anything before or done financial analysis. The nice thing is, rather than you training them, what we can do is just give them videos to watch. Walk them through a lot of this stuff, like even videos from the class, so they can watch the videos and teach themselves. We're trying to get our freshmen and sophomores way ahead of everybody else in all the other schools. Just because of the AI and everything going on, we need to get them so that when they go into interviews, it's just like, what school did you go to? And I want that question in a good way. It's like, what school did you go to? That's not what I want. I was like, what school did you go to? You go to Harvard? Where did you go? So we have 2 more screenings to do. And then this is what you're going to do. So you're essentially going to do this, but you're going to do it high level to try to get down to your final pitch. And then you're going to start building your pitch book. And then you're going to do it much more detailed on that company you're doing. And I gave you an example of a pitch book on Canvas from CFI. I also on WhatsApp, I want to find it again. I gave you some pitch book presentation examples. I don't know if y'all remember that. So, you need some practice with that as well. It's not radically different what you're already doing. But here's CFI stock pitch on Amazon. So you can kind of see their format, what kind of things they show. So, I mean, you can't completely copy this because every company is going to have a different set of stuff they're going to do. But essentially what your goal is what we start off with here. What is it that's unique? So it's storytelling. You gotta get people excited about the company. What is it that's great about this company? And a lot of it's the future. What are they doing? So like the media and the entertainment, it's those people who are gonna figure out how to get people engaged. So I like what they said, that it used to be media controlled what you saw when you saw it, and you're under the control. Now the consumer says, hey, you figure out what I want. When I click on what I want to see is sitting there. It's kind of scary to think that we've gotten that lazy as human beings. It's like everything, I just want you to go from TikTok. And I'm pretty amazed, my worry with my video feeds is I'm starting to see the same stuff over and again. So I'm like, why do they think I want to see this? Kind of interesting. So I'm worried that it's kind of getting monotonous, and I don't know how to flip out and say, give me something radically different. I'm tired of cat videos. I'm tired of recipe videos. But they did a good job, and all of your teams, we talked about this, all of your teams should say, this is what I see about this industry, and the winners in this industry are the ones that are doing this. The losers are the ones that are going to do. That's one of the questions I got, right? They said, you talk about the winners, who are going to losers going to be? So you want to have that clear. The same thing with your stock pitch. This is going to be one of the winners in the industry because they've got this part of this down. So it's the storytelling part of it. That's why I recommended the Motorins video, YouTube video on storytelling and stock pitches, because it really is what you're doing. You've got to get that story down. All right, any questions on this? I'll save this out there. So we'll start working on the screening models here, and you need to start working on your stock pitches. Let me show you the models we have real quickly. So you see the financial analysis, y'all know where this one is. And there is a video that shows you how to set it up. I don't know if you got Friday yet. There's a video that shows you how to bring all the stocks in and do the analysis. So that's all there. It is tied to Cap IQ. So if you don't have Cap IQ working, you can use it in the FSC and it should work well. How many of y'all have Cap IQ working from home? A couple of you. Mine was, and I'm getting these error messages again, so it's pretty irritating, but you can definitely get it to work in the financial lab. So you got that one, that gives you the financial analysis. Valuation, here's my valuation model, and again, it's going to give me error messages because it's on Bloomberg. So what I did is I had so many files set up with Bloomberg, and then as I saw Cap IQ out there so much, I learned Cap IQ. So I converted the finance analysis model to Cap IQ just so I could learn Cap IQ. I would recommend you be able to build a model in both. This one's all Bloomberg. So that's why you're getting error messages, but let's look at, it does have a tutorial video as well. That's why I'm saying when you get a team member, rather than you sitting there and training them, that you can just watch the video and learn it themselves. So it starts off with the football chart. This football chart is simply random numbers. So it's not an actual football chart, so you'll have to put your numbers in there, but have it set up. The DCF valuation, it's not going to work because of the Bloomberg, but you have one on the discount rate itself. You put in the ticker. When you put in the ticker, it's going to pull the data that you need. It uses CAPM. Is CAPM the right model to use? What is it? Damn it, the Morgan, what do you say? CAPM is the worst model out there except for all the others. So anybody have a recommendation for a different model? So CAPM, I like CAPM if you treat beta as a forecast and not as a regression number. I even have a t-shirt that says that. Beta is not a number you look up in Yahoo Finance. Can y'all believe I have a t-shirt that actually says that? I say it so much, huh?
You really?
Yeah, the investment society bought it for me. Beta is not a number you look up in Yahoo Finance. I do, I should wear it to class. So I like the cap asset pricing model if you treat beta as a forecast, just like any other number is a forecast. The historical beta is interesting. So the risk-free rate, you have here the Bloomberg data pool, which includes yields. It also includes the tips so that you can see if you need a forecast inflation, you get an inflation number off the bond market. So it even brings that in there. It brings in the dividend yield on the market. We'll walk through this model if you haven't had valuation in a while. It brings in actual earnings and revenue growth over 3, 5, and 10 years for the company. So you can see some historical growth in there. I'll have to update that. It brings in the PEG ratio to try to see what is the market thinks growth going to be using the PEG ratio. It brings in return on capital to do kind of a sustainable growth rate. Some of y'all have had me before. If not, we'll go through that again next class. It brings in free cash flow to equity, just to give you a substitute for dividends. You can kind of do a free cash flow valuation. And it brings in their price. So all of this is tied to Bloomberg, so I can't bring it in. It's Bloomberg data point, brings in each one of these. But as soon as you open this model on a Bloomberg machine, so all of you have a Bloomberg account, you change the ticker, it's going to populate it. You'll actually get a valuation, but you'll get a valuation using my assumption for Walmart, which if you're doing NVIDIA might not be a good assumption. All right, so all the data is tied there. And then you got to come up with the discount rate. It walks you through that process. We'll do that next class. I'm going to assume y'all have never had this before, but like Fort Carson's had this twice with me. Sebastian's and Blake, some of y'all have seen this multiple times. But I'm assuming you've never seen this before, but y'all have all done discounted cash flows, right? You know how to do dividend discount model. It's pretty standard, but if not, we'll still do it. You notice I do base, bull, and bear. So I'm a believer that you don't value stocks, create stock distribution. You do the distribution of the stock price. You're trying to figure out how high it could be, how low it could be, and where it is in the middle. Now, how do you get a target price? We'll talk about how you can get a target price when you have multiple prices to look at. So you will have a target price, but we're going to do a base case, bull case, and bear case. There's your betas. Then you have DCF valuation. Here we need some growth rates. We have historical growth rates. We have the growth rate implied by the PEG ratio. We have the growth rate implied by ROE. I also brought in the Bloomberg estimate. And if you watch the video, it shows you, so Bloomberg, if you type EE in Bloomberg, it brings earnings estimates, so you can see what Bloomberg analysts are thinking on this. You can get earnings per share growth and revenue growth. Also, the file we're using for Capital IQ does the same thing, but it's entirely dependent on historical growth. It kind of extrapolates the history, so it may not be so strong. Are these people better forecasters than you? What's the record of Wall Street analysts forecasting? So pathetic is pretty much what you say. We're all humans are horrible forecasters. But is their forecast better than everybody else? Who knows? What does the data show? But at least you have someone to say that Walmart's going to grow its EPS from 255 to 355 or 360 over the next few years. That's a pretty hefty growth. They can grow the revenue from 7 trillion or 700 billion to 810 billion. Who knows? But you have those numbers. You have to put in your scenarios. As I say, ultimately, your growth rate is population growth plus inflation. I mean, ultimately, that's everybody. And what are populations doing? They're shrinking, right? So ultimately, that's where you're going to be. But you have to come up with your assumptions. You have a long-term growth, short-term growth. You need your dividend zero, which I get from Bloomberg. I don't know how I got that from Bloomberg, and it's showing. And then free cash flow per share. And then you have your valuations. I use 2 dividend discount models, the dividend discount model and the H model. I love the H model. It's a really, really fun model to use, pretty simple to use. All right, so I'll walk through this one on Tuesday. I'll copy and paste the values. I thought about having a class in the FSC, but it's just going to be too crowded in there. So I think I'll just bring it in. You can watch the videos and figure that out. All right, so Tuesday we'll work on this one, and I'll go through. It may take us more on Tuesday. I'll go through my theories on valuation and on discount rates, and then we'll walk through these other 2, maybe the Tuesdays after that. So by mid-October, in 2 weeks, you should have everything you need for your stock pitches. And then we'll see. I'm trying to get outside speakers to speak some of those other days. Your team meetings are extremely important. You might say, why do we need team meetings now? Because we're doing individual stuff. The reason for the team meetings is to give me one-on-one time with you to help you overcome problems. So I want you at the team meetings. If you can't make the team meetings, set up a time some other time in the week to meet with me. I want to make sure everybody's where they need to be. I don't want to come, November, coming out of Thanksgiving, and one student's like 7 months behind. And it's possible in this class to be more months behind than the semester is long, because if you get behind, it just snowballs. You get so far behind. So you got to, that's the reason for that weekly team meeting, is I want to keep stressing you out, keep pushing, so you don't get behind. All right, any questions? I'll save this out there. I don't know where I'll put it out there. Everybody understand where we're going from here? All right. Tuesday, we have every team meeting. I don't know, at 7:30, how we'll break it up. We might have semiconductors go first. We'll see. We'll break it up, but we'll have to watch the time Thursday night so that we don't go past 8:45. So we'll watch. Today's team was about 10 minutes, and the questions are about 10 minutes. It was about right. Be real careful that your team doesn't go over 15 minutes. All right. Time it. And again, if you're struggling with the words, write it out and read it so that you don't get tongue-tied while you're going. All right, I'll stop it there. Make sure I have you on attendance.